How do we calculate free cash flow? Ever wonder how much money a company actually has to play with? We're not talking about revenue, we're talking about cold, hard cash. That, my friends, is the magic of free cash flow, and understanding it can make you a smarter investor. As investors, why should we care about free cash flow? Understanding free cash flow is crucial for investors as it indicates a company's financial health, ability to generate cash, fund growth, pay dividends, and reduce debt, ensuring long term sustainability. And we need to know how to calculate it correctly. So, how do we calculate free cash flow? Let's break it down. Free cash flow equals operating cash flow minus capital expenditures. Let's look at each component, all of which are found on the cash flow statement. First up, operating cash flow. This is the cash a company generates from its core business operations. Think selling products or providing services. Next, we subtract capital expenditures or CapEx. This is the money spent on long term investments like buying new equipment or upgrading facilities. Try to think of it like this: operating cash flow is the money coming in, and CapEx is the money going out to keep the business running and growing. So, what's left after we subtract CapEx from operating cash flow? You guessed it, free cash flow. To put this into practice with a real life company, let's look at an example, say Visa, one of my favorite companies. Visa is a cash flow generating machine and it has a long history of creating value via their cash flow. So let's get to calculating. We find both the operating cash flow of 20.7 billion and capex of 1 billion from the cash flow statement like here. We then extract the numbers and perform our simple math and voila, free cash flow of 19.6 billion in 2023. Now you're probably asking yourself, so what can Visa do with this? Visa can do all sorts of things, such as pay dividends to investors, buy back stock, pay down debt, make strategic acquisitions, invest in research and development. So in Visa's case, we can see the company paid $0 for acquisitions, 12.1 billion in stock buybacks, 2.3 billion in debt repayments, and 3.7 billion in dividends. Essentially, free cash flow gives companies the flexibility to create value for their shareholders and fuel future growth. So the next time you're evaluating a company, don't just look at top line revenue. Dig a little deeper and uncover the power of free cash flow. It might just lead to your next winning investment. Hope you found this helpful. Want to learn more about analyzing financial statements like a pro? Subscribe to our channel for more interesting tips and tricks.